Welcome to Iron Financial. We're the only place that forges stronger portfolios by cutting right through the market noise. I'm your lead analyst. Today, we're not just glancing at an earnings report. Oh no, we are conducting a full-scale financial stress test on Sturm, Ruger and Company, ticker RGR. We're going to put this company's entire structure under some serious pressure. We need to find out if its foundation is truly built from solid steel or if it's just about to collapse under the weight of its own failures. All right, let's get into it. And right out of the gate, we're hit with a paradox. I mean, a real fundamental contradiction that basically defines this whole story. Just look at the left side of your screen. Ruger's full-year revenue for 2025, it actually ticked up almost 2%, landing at $546.1 million. Now that's a pretty solid number that even beat what Wall Street was expecting. So you see that and you think, okay, not bad, healthy demand, solid execution. But then you look over to the right side of the ledger and the entire narrative just gets flipped completely upside down. The company went from making a respectable $30.6 million profit in 2024 to a $4.4 million loss in 2025. You heard that right. Sales are up, but the profits, they've been totally vaporized. This is the central mystery we are here to solve. How on earth does a company sell more stuff and end up losing money? It just doesn't add up.
Okay, wait, hold on a minute. A $4.4 million loss is bad enough, I get that, but look at it on a per-share basis. This is where the real damage becomes just impossible to ignore. A negative 27 cents per share. Last year, they made $1.77. Let's be clear, that's not just a decline. That's like driving your car straight off a cliff. We're talking about a more than 115% drop-off. So let me just get this straight. You're telling me the company is out there, successfully selling more of its product, revenue is actually going up, and yet somehow they've managed to completely obliterate shareholder earnings? Something is fundamentally broken here. I mean, deep inside the operational structure. This isn't just some little crack in the wall. This is the main water pipe bursting and flooding the entire building. That's exactly right. And to figure out where those pipes burst, we're running our signature 5-part stress test. First, we're going to examine the report itself, all those surface-level contradictions. Second, we are going to deconstruct that profit collapse piece by painful piece. Third, we'll analyze the financial foundation, the balance sheet, to see if it can even handle this kind of structural damage. Fourth, we're going to put management's official rebuilding plan under the microscope and see if it's a credible blueprint or just wishful thinking. And finally, we will deliver our verdict. Is Ruger an overlooked opportunity with a solid core, or is it a classic value trap just waiting to spring on you? Okay, let's start the drill down. Part 1, the contradictory report. At first glance, you look at the headlines from the fourth quarter of 2025, and it looks like a mixed bag, right? A classic beat here, a miss there. But like always, the real story, the one that matters, is buried in the details. And trust me, it reveals a much more complicated and, frankly, concerning picture. Now, this table is fascinating. And it's fascinating because of the sheer scale of the beats, especially when you put it next to the miss. Let's look at the top line, revenue. Analysts were calling for about $139 million. Ruger comes in with over $151 million. Now, that's not just a beat. It's a huge 8.5% beat. That tells you demand is strong. Then, look down at the bottom of this table, adjusted EBITDA. That's your earnings before interest, taxes, depreciation, and amortization. Wall Street expected maybe $11.2 million. Ruger delivered a staggering $29.5 million. They didn't just beat that expectation, they blew it out of the water by more than 160%. But right there in the middle, sandwiched between all that good news, is the poison pill, adjusted earnings per share. They were supposed to deliver 32 cents. They only managed 26. So what do we have? Top-line sales look great. A key measure of cash flow looks incredible. But the actual bottom-line profitability for you, the shareholder, is weak. This isn't just a contradiction, it's a massive flashing red warning sign. Yeah, and before we get all excited about one good quarter of revenue, let's do ourselves a favor and zoom out. You can't build a serious investment thesis on a 3-month window. What does the 5-year blueprint actually look like? Well, this slide right here, it shows a company that is going absolutely nowhere on the top line. For 5 years, revenue has been stuck in the mud, completely flat. But while sales have just been treading water, profitability, it's been in a complete and total freefall. Earnings per share have gone down by an average of nearly 25% per year for 5 years straight. You see, this isn't some new problem. This is not a one-quarter hiccup. No, this is a long-term systemic erosion of profitability. It points to a company that just can't control its costs, can't command any pricing power, and is fundamentally struggling to create any real value from its day-to-day operations. And that's the perfect lead-in to the heart of our investigation. Part 2, deconstructing the profit collapse.
It's time to put on the forensic gloves and perform an autopsy on the profit and loss statement. We know the revenue came in the front door, but somewhere along the way, the profit never made it out the back. We need to find out exactly where the money went.
And here it is, the financial crime scene laid bare for all to see. Let's just follow the money down this table, starting right at the top. Net sales, up 1.9%, or about $10.5 million. Look, it's a small win, but it's a win. But then look at the very next line. Cost of products sold. This is the direct cost to actually make their goods. Materials, labor, the factory overhead. It absolutely exploded by over 10%. That's an increase of almost $44 million. Think about that. It grew more than 5 times faster than their sales did. That single disconnect is what utterly crushed their gross profit, which just plummeted by nearly 30%. But the bleeding didn't stop there. Below that, you've got operating expenses. You know, things like selling, general, and administrative costs. Those also ballooned by almost 13%. So what's the story? For every new dollar of revenue Ruger brought in, they ended up spending multiples of that dollar on higher costs and higher expenses. This isn't a revenue problem. This is a severe, out-of-control cost and expense problem. This next chart gives you a really brutal visual of that cost disaster. It shows the company's EBITDA margin. You should think of this as a core measure of a company's operating profitability. So back in 2024, for every $100 in sales, Ruger generated about $10.30 in EBITDA. You know, a decent margin, not spectacular, but decent. In 2025, as you can see, that number got cut almost perfectly in half, all the way down to just $5.40. They are making nearly 50% less profit on each and every dollar of sales than they were just 1 year ago. This is a catastrophic failure in efficiency. It's a clear signal that the underlying business operations are under extreme stress. This is exactly the kind of margin compression that sets off deafening alarm bells for any serious analyst. So the company is absolutely bleeding profit. And this slide here, this is their explanation. Management wants us to believe that all these issues are just one-time things. They've served up a whole buffet of excuses, all dressed up in fancy corporate jargon. Let's start with the biggest one, inventory rationalization, which conveniently came with a massive $17 million write-off. Is that just a fancy way of saying, hey, we completely misjudged the market, we built a mountain of products that absolutely nobody wanted, and now we have to throw it all away at a huge loss? And then we have product rationalization, organizational realignment, leadership transition costs. The list just goes on and on. My question is, how many one-time adjustments can a company have in a single year before it just becomes a clear pattern of poor management and terrible execution? Are these legitimate one-offs, or are they just trying to paper over the giant cracks in a crumbling business model? And you've hit on precisely why they want you to focus on this number, adjusted EPS. This is a non-GAAP, or non-standard accounting metric. The entire purpose of a number like adjusted EPS is to take the official legally required GAAP number, which remember was a loss of 27 cents, and surgically remove all those bad things we just saw on the last slide. After they wave their magic accounting wand, their loss magically transforms into a profit of 84 cents per share. Now, management will argue that this adjusted number gives you a better, truer picture of the underlying earning power of the company, free from all that one-time noise. But your point is absolutely critical. Those one-time costs were very real. That $17 million inventory write-off, that was real cash, real resources that are now gone forever. You have to look at both numbers to get the full story, the official loss and management's adjusted profit. All right, now even a poorly constructed building can sometimes survive a nasty storm if it's built on a solid foundation. And that brings us to part 3 of our stress test, analyzing the financial foundation. We've seen that the profit and loss statement shows a structure that is basically on fire. Now we need to go down to the basement and inspect the balance sheet to see if the bedrock underneath is strong enough to prevent a total collapse. And this, right here, this number is the single most powerful component of the entire bull case for Ruger. 0. The company has absolutely zero debt. In today's world of rising interest rates, where debt can be a giant anchor that sinks a company, Ruger has none of it. This is the financial equivalent of building your house on solid granite. It gives them immense flexibility and a ton of resilience. They don't have to worry about making interest payments to banks. They can use every single dollar of cash flow to fix the business, to innovate, and to return capital to shareholders. This right here is the steel-reinforced concrete of their financial foundation. It's incredibly strong. And the foundation isn't just about the absence of debt. It's also about the presence of real strength. And Ruger has that strength in spades.
First, just look at their cash position. $92.5 million in cash and short-term investments. For a company this size, that is a massive war chest. Next, their current ratio, which is a key measure of liquidity. At 3.9 to 1, it means they have nearly $4 of short-term assets for every $1 of short-term liabilities. That is just incredibly healthy. And here's what might be the most impressive part. Even in a year where they posted a net loss, they still generated over $54 million in cash from their operations. And what did they do with it? They used that cash to return over $36 million back to shareholders through dividends and stock buybacks. This is a company that, despite all its profitability problems, is an absolute cash-generating machine with a fortress balance sheet.
Okay, hold on. A fortress balance sheet is great. Zero debt? Fantastic. But a strong foundation is completely meaningless if you can't build a profitable business on top of it. It's like owning the world's best bomb shelter, but the house above it is collapsing in on itself. Who cares how much cash you have if your core operations are just burning through it? All this talk of a solid foundation doesn't solve the central problem we identified 5 minutes ago. Their margins are collapsing. They can't turn their sales into actual profit. So I'll ask the question again. If the foundation is so solid, why is the rest of the structure on fire? A strong balance sheet can buy you some time, sure, but it can't fix a fundamentally broken business model. And that is the billion-dollar question that leads us right into our fourth section, management's rebuilding plan. Acknowledging you have a problem is the first step, and it seems they've done that. But now we have to determine if management has a credible blueprint to actually put out the fire and patch up the serious cracks in the structure. It's time to evaluate the architects of this supposed turnaround.
And we'll start with the CEO, Todd Seyfert, in his own words. Increasing profitability, aligning our manufacturing footprint with demand, and right-sizing the business for the future are not optional, they are essential. This is exactly what investors need to be hearing right now. This isn't just happy talk, this is a clear acknowledgement, straight from the top, that the status quo is completely unacceptable. He's openly admitting that the company has major issues with profitability, with efficiency, and with its overall size. This quote signals to me that management isn't in denial, they see the fire, and this is the official start of their plan to try and extinguish it. And a key pillar of their rebuilding plan is clearly innovation, as this chart shows. Look at this. 1/3 of all firearm sales in 2025, a full $173 million worth, came from products that are less than 2 years old. This is incredibly important. It proves the research and development pipeline is actually working. They're creating new products that customers are genuinely excited to buy. This isn't just some company resting on its laurels and its legacy. It's actively building the next generation of revenue streams. This innovation is like the new load-bearing wall in their structure, and it is a major reason why their sales numbers are outperforming the broader market. But is that innovation really driving new growth, or is it just cannibalizing sales of their older products? Because this slide presents a fundamental conflict that I just can't reconcile. On the left side, you have the company's version of the story. They say that the actual sales of their products from distributors to retailers, which is the real measure of consumer demand, is up 4.5%. That's impressive, no doubt, especially when the overall market, measured by background checks, is actually down over 4%. They are clearly gaining market share. But then you look to the right. The professional analysts on Wall Street, the people whose entire job is to forecast the future, are telling a completely different story. They expect Ruger's revenue to actually decline by 2.7% over the next year. So who are you supposed to believe? The company's own real-time sales data or the pessimistic projections from the analysts?
And that conflict brings us right to the final section of our stress test, where we have to weigh all the evidence we've just laid out. Part 5, the verdict. Is Sturm, Ruger & Company a deeply undervalued opportunity just waiting to be discovered, or is it a classic value trap? It's time to lay out the final blueprint, summarizing the full bull case and the full bear case, so you can make an informed decision for yourself.
So after our full stress test, the entire investment case really boils down to this one slide. Let's start on the left with the bull case, the opportunity. The foundation is undeniable. Zero debt and a massive $92.5 million cash pile. That provides a huge margin of safety. The innovation engine is firing on all cylinders, with new products driving 1/3 of sales and helping them gain market share in a really tough environment. This is a company with a rock-solid balance sheet and clear product momentum. But then, on the other side, you have the bear case, the trap. The operational structure is failing, plain and simple. Margins have been chopped in half. The company is losing money even as its sales are going up. Revenue growth has been non-existent for 5 long years, and now Wall Street expects it to turn negative. This is a company with a severe ongoing profitability crisis that it has yet to prove it can solve.
Which brings us to the final question that we are leaving with you. Sturm Ruger has a solid, debt-free foundation, but the structure built on top of it is showing severe cracks and is actively losing money. The CEO has presented a blueprint for a rebuild, and we know new products are providing some much-needed support.
So the choice is really yours. Are you betting on the architect, the management team, to successfully pull off this incredibly difficult turnaround and fix a broken structure?
Or do you look at the collapsing margins, the years of stagnation, and decide it's just too risky, and you walk away from the build site altogether? That's the question every investor now has to answer. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.